AI is driving one of the biggest investment cycles in history, and it's coming to the bond market. Let's take a look at what's happening and how we're using growing dispersion among issuers to manage bond portfolios. Companies have been racing to build the infrastructure for AI, pouring a massive amount of capital into building data centers and compute capacity. There were rumblings early in the year about whether this spending would continue. We got our answer from the recent earnings reports. It's nowhere close to slowing down. In order to fund this spending, companies are increasingly turning to bond markets. In fact, technology issuers, including the hyperscalers, have accounted for about 20% of investment grade supply through the first 4 months of the year. And when you see that type of debt growth, the natural instinct is to equate it with risk. That's exactly what happened during the dot-com boom in the early 2000s, as well as the energy boom in the 2010s. But today, if you look at the biggest tech borrowers, and particularly those hyperscalers, they're generally companies with low leverage, high cash balances, strong credit ratings, and really strong access to capital markets. It's a very different starting point from prior CapEx booms. That's not to say there isn't risk, but what's happening is that this risk is showing up in more selective or idiosyncratic ways. Different business models have different exposures to AI disruption and CapEx. As a result, we're seeing credit spreads move less in unison and more at the issuer level. And that's not just at tech. That's at a variety of industries that AI disruption is affecting, including software, business services, utilities, insurance companies, and many other sectors. Our teams at Voya have built frameworks in order to understand how these issuers may be affected by AI, allowing us to select credits that we think are in a strong position to succeed. Overall, fixed income continues to offer very attractive entry points to high levels of income, supported by strong underlying growth as well as strong credit fundamentals. The key is finding the right exposures. To learn about how this trend is affecting fixed income portfolios, please reach out to your Voya representative or read the latest fixed income perspectives at voyainvestments.com.